Everything we discuss here is not financial advice. This is purely for educational basis. Do read the disclaimer. So today I wanted to discuss something slightly different to what we normally discuss, which is maybe a bit more actionable, a bit more market-centric, and a lot more trading focused. Today I wanted to move a step back, and there's a very deliberate reason why I'm doing this, because as we go into 2025, I think we need to move from the trading mindset to a more portfolio manager stock pickers mindset, because we're going into a new year and that's how the whole market will be focused. And also with the elections out of the way, volatility has come back down to normal levels. So as volatility decreases, we need to be a little bit more like a portfolio manager. And as volatility increases, we need to move more into the trading mindset. So we get more short-term focus when volatility is high. And when volatility is lower, we get a little bit more long-term focused. It doesn't mean that we stray in terms of our defined time horizon. It just means that we know when volatility is higher, our moves will happen quicker. So we adapt our approach to that. But on today's agenda, I wanted to go back to fundamentals and explain exactly what is an equity, what is the capital structure of a company, what makes up a company. We see a lot of tickers, and a lot of times I think we assume we understand a lot of what the information we're looking at means. And this session is basically to validate this and to plug any gaps that any one of you might have. We have to be cognizant that not everyone comes from a financial background and has a deep understanding of financial data, financial statements, and so on. So that's one gap I wanted to bridge with the session today. So we'll go through the capital structure, what makes the equity of a company grow, and then what are the factors that drive long-term equity appreciation. We'll look through some examples as well. And then, as I discussed on the Discord server, one topic that will be of primary importance going forward would be free cash flow generation. So as we look into the market and want to buy quality companies, we need to have a very thorough understanding of what free cash flow is and how companies are able to improve their free cash flow generation. But most importantly, why is this something that we need to pay close attention to? What's the relationship with free cash flow generation and the long-term equity appreciation? And finally, I'll speak a little bit about the fundamental stock analysis process. Starting off, what is the capital structure? So capital structure is comprised of the equity and debt portions. Think about it as you starting a new company, right? You will have your share capital. Let's say you put aside $10,000 for the share capital of the company. And then maybe you'll have outside investors that will give you another $10,000. So your capital structure comprises of $10,000 of share capital and then $10,000 of debt, right? And it's exactly the same for these larger companies. So a lot of companies, when they come to market, the reason they list themselves on the equity markets is to raise capital. And a large part of that capital is the equity portion. So for many of these companies that are trading out there, you will normally look at the balance sheet and see that there are two parts in the balance sheet. One is the capital portion and the other part is the debt portion. And it's important to understand what's the makeup of companies from that perspective. So the debt portion consists of fixed income instruments. The company will pay back a regular interest to the issuers of the debt. And at the end of the term of the debt, the company will settle the principal amount. As an example, let's say a company has taken $1 billion in debt over a term of 5 years. and the interest rate is 10%. So every year it will pay 10% of $1 billion to the debt holder. And then at the end of the 5 years, it will pay back the $1 billion to the debt holders. So the payments here are defined, and we also know exactly when they will happen in time. We also have other debt instruments that are more like hybrids of equity and fixed income. So in this case, it's still like a fixed income instrument, but the debt holder can convert a portion of that debt into equity under certain conditions. You would have seen on the Discord server, I've spoken a little bit about convertible debt instruments. So that's essentially what I mean by the hybrids. Not something I'll go too much into detail here, but it's important to know that they are part of all these debt instruments as well. The equity and debt instruments can either be private, which means these are private agreements signed between different parties, or they could be public, which means they are listed on the stock exchange as per the stock exchange rules. So when they're listed on the stock exchange, it means everyone who has access to the stock exchange can participate in that equity or debt offering. So even the debt instruments are listed on the stock exchange. We don't particularly talk about fixed income or debt in our Discord server, but there is a large market for fixed income instruments that's publicly listed and trading on every single day. Very similar to the equity markets. Actually, sometimes even bigger than the equity markets. Moving on, so when it comes to what differentiates debt instruments from equity, it's all to do with where they rank in terms of prioritization when it comes to access to cash flows and assets of the company. So debt holders will have a higher level of priority for access to the cash flows and assets of the company than equity holders. What does that mean? In a liquidation process, basically, let's say you have a company and then you decide to stop the company and sell all the assets. So the debt holders will be paid off first. All the cash flows from the proceeds of the sale will go first to the debt holders to relieve the company of all its obligation towards the debt holders. And then if anything is left, then a portion of the remaining funds will go to the equity holders. So you can see that it's a lot safer to be a debt holder than to be an equity holder. Because as a debt holder, you know your obligations, you know the company's obligations towards you. And also, there is a higher chance that you'll get paid those obligations. As an equity holder, you're almost like the guy who's at the bottom of the process. And if anything's left, then you'll get that. That's going to be what the equity portion of the company will be worth. So by virtue of that, because there's more risk involved, the equity portion is normally more prone to volatility. The variability in what equity holders will get or what they assume they'll get in a liquidation process is much higher. So, of course, there's more speculation. And this happens not just for companies that are about to go bankrupt, because now everyone's going to have a guess as to what the assets of the company are worth and for how much they'll be able to sell them to someone else, get the proceeds and then distribute it amongst the debt holders and equity holders. It also happens on the way up. So as a company is growing, then the equity portion grows a lot quicker. I mean, it's a generalization, but what I mean by there's more variability is because those estimates on future growth are more variable, and we know exactly what the debt portion consists of and how much of the cash flows will go to the debt holders. So there's very little speculation on how much the debt portion is worth or valued at versus the equity. Because at the end of the day, the cash flow that the company is making minus what's paid to the debt is equal to the equity portion, or is attributable to the equity portion. So the debt portion is fixed in nature or almost known to a large extent, and therefore has less variability in terms of what that's valued at. And that's why you see in the financial markets, the equity markets are the ones that have the highest volatility. So if you were to compare, let's say, equity markets to corporate fixed income instruments, to Forex, to commodities, to maybe not crypto, because crypto is kind of a new type of assets that's just come about. But if you were to do a historical analysis on what volatility is like, you'll tend to find that equity markets tend to have the highest volatility. Also, it's important to note that different investors choose different asset classes to achieve their varying investment objectives. Some investors have a bigger need for capital protection, while others have a bigger need for capital appreciation. I'll give you an example. Let's say you have a pension fund, and the pension fund has defined liabilities to its members. So in order to match these defined liabilities, the pension fund will go out and buy fixed income instruments that pay cash flows in excess or equal or in excess of what the liabilities are. So in that case, we'll say that the pension fund is able to meet its liabilities towards its members. And the pension fund doesn't necessarily need capital appreciation in this case, right? Its primary concern is to be able to pay its members as per its obligations to these members. Whereas if you compare that situation to someone like ourselves who are in the market and has a lower need for capital protection but a higher need for capital appreciation, then we would tend towards more of an equity type investment as opposed to fixed income instruments. It doesn't mean we cannot do both of them. Just showing you the two far ends of the spectrum. So you have investors who lie at the far left, investors who lie at the far right, and then you also have a bunch of investors all the way in the middle of the spectrum. So we focus predominantly on the equity value, right? Let's understand what makes the equity value of a company grow. So the purpose of a company is to sell goods and services to generate revenue, right? And then in order to generate that revenue, it needs to buy inventory to fulfill the orders. So the cost of buying inventory would be referred to as cost of goods sold. If you pull up an income statement, you would see these terms there: revenue, cost of goods sold, etc. And then for the company to process the raw materials and then turn it into the actual goods and services that it sells, it has to incur operational expenses such as salaries, rent, leases, utilities, and so on. The company then also maybe has debt, which means that it needs to pay its debt holders in the form of interest payments. So that's another expense that the company will have. At the end of the day, the company also needs to set aside funds for what we call maintenance capex, which essentially means, let's say if you have a factory, it will be depreciating at a rate of maybe 10% per year, and you probably need to do repairs and maintenance, which would amount to that level. That's an approximation, but you get what I mean, right? If you have a factory and every year you need to do servicing of your equipment, that's going to cost you something, so you have to put aside funds for that. We also have what we call growth capex, which is basically funds that are earmarked for expansion. Let's say you want to buy another factory, you want to buy more equipment, you want to expand the number of stores that you're selling into. So you will need to set aside funds for that expansion plan, right? So at the end of the day, when all of that has happened, so the company has earned revenue, bought inventory, paid its operational expenses, paid back its interest payment on the debt, also set aside some funds for maintenance and growth capex, the company will have something as a remaining cash flow, hopefully. And not to forget that the company might also have one-off payments every now and then. This could be in the form of maybe there's a lawsuit settlement, an acquisition that they are making, some restructuring costs, and these things are not, they don't happen every quarter, but they would tend to happen every now and then. So after all these cash flows have been set aside and earned, the company will remain with a net cash flow. And this is the portion that accrues to the equity portion. So the purpose of a business is to be able to generate revenue, use part of it for its expenses, and then at the end of the day, be left with something that accrues to the equity portion of the company. You would remember my analogy of a water tank, right? The purpose of the company here is to make sure that after water comes in and leaves the tank, that over time, the water level in the tank is going higher. The water level in the tank here is the equity portion. So at the end of the day, income minus expenses must be positive. And this is essentially what will grow the equity value of the company over the long-term basis. So I have a few examples in the next few slides to illustrate this, just in case you don't believe me. But also think about this from your perspective. Let's say you're starting a new business, right? Maybe at the beginning, your net cash flow will be negative because you have to, buy quite a few things firsthand, and these would be one-off expenses and so on. But after you get to a normal stage where you're just running the business, then you need to set the numbers in such a way that every quarter you're actually adding to your business bank account, as opposed to, paying or being negative from a cash flow perspective. That's a good business. If you have a business where consistently you're negative in terms of net cash flow, that does not tend to be a very good business, and eventually it will go out of business, because every time your net cash flow is negative, you're essentially just chipping away at this equity portion here. So let's say you have a company, every year its net cash flow is negative 500 billion, right? So after year one, the equity portion will be worth 1.5 billion. After year two, it will be 1 billion. And then you can see, right, after year four, the company will not even exist because the equity portion will be zero, which means the company is bankrupt. It might even go bankrupt much earlier, but that's essentially what I'm trying to say. The water tank just goes to zero and it dries up. And as an investor, this is the last thing you want to see happen to your company. Now, when it comes to equity markets themselves, right? So the equity value normally is referred to as the intrinsic value of the company. You might have seen this term being floated around a lot it's more in the investing community that they will be using this. But even in the trading community, this is a fairly regularly used term. So there are various valuation mechanisms to calculate the intrinsic value of a company. We have the first one, which is the relative valuation mechanism. So this is basically where you apply a multiple which is in line with a comparable company, and you apply that multiple to its net cash flows. So as an example, let's say I have an e-commerce business that makes 100,000 net cash flow at the end of the year, and someone wants to buy it off me. So what I'm going to do is I'm going to look at similar businesses that have been sold in the recent past, and let's say they apply a multiple of 4 times net cash flow. So I'm going to quote the buyer 400,000 for my business, and we might agree on 400,000, 350, but essentially what I'm saying is I'm going to be looking at the market for the most recent transactions for the most comparable business, and I'll apply that same multiple to my net cash flows. We also have what we call the asset-based valuation mechanism. So this is basically what would the equity portion be worth if the company sold all its asset and paid off all its debt. So going back to, let's say, my internet business, if I were to sell it off and then if I were to, let's say, tomorrow decide that I want to stop operating it, basically what does that mean? I'm going to sell all my assets. So what would I have in terms of assets? Probably inventory. Maybe I have a warehouse. Maybe I have a few other things that I can sell. And then I have, from the proceeds of this sale, I have to pay off my debt holders. And after I've relieved myself of all these obligations, the funds that would be left would be attributable to the equity portion. So all the equity investors will have a claim on that fund in proportion to how much of the equity they own. So this is a situation, or this is a method that's mostly used when you're looking at bankrupt situations, companies emerging from bankruptcies and so on. Normally, we would tend to use more of a relative valuation mechanism because we have a live trading market where every single day we are getting the multiples at which the comparable companies are being sold at. So that's a lot easier to use, and it's a lot more in sync with what investors are willing, and what investors are willing to value companies at. So when it comes to the stock market now, you have another price that's called the share price. So this is the share price that you see on your screen that moves every single minute as the market is open. So this share price will tend to fluctuate around the intrinsic value. It's important to understand that every investor out there in the market will have their own unique estimate of the intrinsic value. So maybe I will say, okay, this company is worth $40 per share. Some other guy might think it's 45. Another one who's a lot more bullish might say 60. Someone who's a bit more pessimistic might say 35. And the share price would essentially be an average of all these intrinsic values that people are calculating out there. And the share price is, you can almost think about the share market as a voting mechanism. People influence the share price by virtue of the buying and selling decisions that they are making. So the guys who think that the intrinsic value is 60, they will be buying the share price if it's probably at 35. But the guys who think that the intrinsic value is 25 will not be buying the share if it's trading at 35. So they probably would be sellers of the share. And when the buyers and sellers are out there making live deals or live transactions, the share price is also moving in accordance. And what you see on your screen is essentially what I would deem the equilibrium price that both buyers and sellers are able to agree on at that point in time. So I remember when I was starting out, the first question I had was, what is this number, this share price? What does that mean? And who's actually setting it? Why is it changing every second? And it's important to understand, things from a more fundamental perspective, walk a few steps backwards and understand the underpinnings of the market. What is actually happening in the background that's causing that share price to move every single minute, every single second? Another thing to also note is that the share price will also factor in people's macroeconomic views. So what's their view on inflation, interest rates? Where are we at in the business cycle? What's their views on the company's future? What's the views on the industry? So this is called the micro part of the thesis versus the macro part, which is, all the global GDPs, inflation, interest rates, and so on. And finally, we also have to understand that market conditions also impact where the share price is trading. So these would be things like, what are liquidity conditions like? In a market where there's a lot of liquidity, then share prices would tend to go higher because there's more liquidity out there, right? So buyers are not that worried about getting the best price, and they're just worried about putting money at play in the market, as opposed to when you have lower liquidity conditions. So let's take an example. March 2020, everyone wants to sell their shares and they don't want to have any risk because they have zero visibility on the future. So liquidity conditions were terrible because there are very few buyers compared to the number of sellers that are out there. So buyers are like, nah, I don't want to buy it here. I'll buy it at 20% lower or 50% lower. Whereas sellers are pressed to sell because they just don't want to go into COVID-19 with a lot of risk and probably having a portfolio that's totally wrongly skewed in terms of what type of risk they would want to have in this new environment. So in line with this, risk sentiment also influences the share price. So a lot of times when we do our price action analysis, you would hear me say that this week has been a pretty risk-on week. This week has been a pretty risk-off week. And this is basically what I'm referring to. Last week, we did look at the risk asset spectrum. So you would have a very good view of what risk sentiment means if you go back to last week's presentation and, just familiarize yourself. As an example, in risk-on scenarios, you would tend to see stocks like energy, stocks like banking, consumer discretionary stocks rally a lot. Whereas in risk-off scenarios, you tend to see more the defensive types of stocks that attract capital to the detriment of cyclicals. So money moves from consumer discretionary to consumer staples, utilities, healthcare, because these are perceived to be less impacted by the business cycle and therefore more or less risky. Let's put it that way. So moving on, this is a slide that we've presented a few weeks ago. It's good to just bring it back so you understand what are the factors that we said at the start influences the share price. On the short-term basis, and by short-term I mean on a less than 6-month scale, it's more to do with shifting future expectations. So as you've seen, analysts are out there covering stocks and industries, and they would regularly provide updates on their views on future outlook on companies and the industry. So as things are happening in the market, as the business cycle is evolving, these expectations keep shifting and the share price also moves in accordance. You have sentiment, we've discussed this just now. We have liquidity conditions and the macro environment. When you move to a more long-term basis, then it tends to be more around valuations. It tends to be more around the business fundamentals. Is this strategy sustainable? How much can this strategy grow over the next few years? How well is management able to execute their operating plan? What has been their track record in the past? And do they fulfill the promises that they make? It would be that type of more subjective view that will influence the long-term share price of a company. Most importantly, it would tend to be around value creation from business operations. So this brings us back to what we've discussed at the start of the presentation. How much value are you creating for the equity portion of the company? So at the end of the day, this comes back to the net cash flow generation ability of the business. If you're not able to generate cash flow on a consistent basis and be positive on a net basis, the equity portion will not grow. And that's why the share price will also tend to maybe move sideways or go down over time, because investors are only going to buy the stock if they forecast that in the future this company has better cash flow generation power, right? Another slide that you would be very familiar with, I'm not going to go too much into details here, but this is more of a short-term, this is more relevant on a short-term basis. So what moves the share price? It's basically at any point in time you have what I call the status quo, and then there's inflow of information from different sources. These information sources goes buyers and sellers of the stock to revisit their thesis, to reassess what they think about the company, and then pen down revised estimates about the company. And these shifting expectations will tend to move the share price. So you would tend to see that a lot of times share prices move quite significantly around earnings. And the reason that happens is because around earnings, that's when you have an influx of information that's directly relatable to that particular company and its industry. So we're no longer looking at broad indices and making assumptions. You have company-specific information that allows you to make a much, much better guess about where the company is going to go in the future. So that information has a lot of value for the future of the share, right? And that's why earnings tend to be extremely strong drivers of share prices. So even if you're a long-term investor, you would need to keep an eye on what's happening to the stock, and you would need to keep an eye on what's happening to your thesis. Is it being proved? Is it being disproved? And for you to do that, you'll need information that's specific to the company, and that information comes every quarter, at least in the US, from the company itself around earnings. So I also wanted to discuss a little bit in terms of what causes long-term equity appreciation. So last week, I think Hader mentioned that he has a preference towards long-term investing as opposed to short-term trading, which is absolutely fine. At the end of the day, we are all market participants, right? So as market participants, we define our opportunity set, our opportunity space as well. And we also define the rules by which we want to play the game. However, irrespective of where you sit as a market participant, the principles that apply to the stock market, to valuations of businesses, do not change. So what changes is how much weight you give to these principles depending on the time frame that you've chosen. In general, shares tend to appreciate quite significantly based on three factors. So one is the earnings generation power of the company. So every quarter you will have the EPS, so basically the earnings per share of the company that would be released. And as this number goes higher, or as it's projected to go higher in the future, the share price will also move higher in line. You also have what we call PE, or price earnings multiple expansion. So you've probably seen in previous presentation where I've alluded that the share price is essentially EPS times the forward PE. So basically, it's the earnings per share times the price earnings ratio based on the earnings per share over the next 12 months. So if the share price is a function of these two factors, it makes sense that the share price will go up if the EPS goes up. But it also makes sense that the PE multiple can also go up. And when would that happen? This would normally happen when the company grows bigger and achieves a lot more stability in its results. Sometimes companies make strategic changes that allow them to reduce cyclicality of their business. So as an example, they can sell different products, they can move from hardware to software offerings. All of these changes have a big impact on the cyclicality of the business. They can also be, the multiple expansion can also be driven by higher sustainable margins. So a company that develops a long-standing competitive advantage is able to have higher sustainable margins in the future. So if you're a long-term investor, you're looking at a stock now, and let's say you expect that you'll hold the stock for the next 5 years. You have to ask yourself, what is the room for the company to keep generating excess margins, so higher than average margins? Why would it be able to generate this type of margins? What is it that's special with that company which will allow it to always earn margins that are higher than its peers? In other words, what's the moat of that company? So that's literally where you'll be focused on, because you're looking out to 5 years, which is a long time scale, right? So what you'll also be asking yourself is, what is the potential for the company to keep generating higher EPS over that time period? So that's going to make a big difference to the share price in 5 years' time. If it's able to grow EPS, let's say, at 20% per year, that's phenomenal growth. And after 5 years, you can expect your share to be worth a lot more than what you paid for it. So as a long-term investor, you have to be able to see that pathway. And if you're able to see this, and your assessment of management, the business, the products that it sells, the market that it's involved in, if all of that checks out and allows you to think that the EPS will grow over time, and also that the company's multiple might also expand over that time period, these are two very strong levers that can cause meaningful appreciation in the equity. So that's literally what you'd be thinking from a long-term investor perspective. And thirdly, because we're looking at long-term investing, dividends policy is also very important. So companies which are smaller do not tend to pay dividends, whereas companies that are a bit larger and have excess cash flow, they would tend to pay regular dividends. The regular dividends can take the form of quarterly dividends, biannually dividends, or even annual dividends. Sometimes you also have potential for special dividends. So these would be one-off dividends that the company can pay. This happens around special events like spin-offs. So let's take an example where a company spins off, means it breaks apart one part of its division, and then that other part will be listed, or it will be listed and trading on its own. So by virtue of that transaction, what can happen sometimes is the company is able to generate excess cash flow from that process. So that can create special dividends for shareholders. You can also have a company that's, instead of just spinning it off, it's able to sell a particular division. So the proceeds of the sale of that division can sometimes be paid back to shareholders, or it could be used for other purposes like paying back debt or reinvesting in the business and so on. So as a long-term investor, you also have to think about these things. So what would be these extra levers that the company could pull to improve the equity value for shareholders? So as a long-term investor, I don't focus this much on dividends policy because the first two are a lot more important. Dividends policy is a bit more of a bonus. It's a bit more of a byproduct of having a very good business, because a very good business generates excess cash flows that can eventually be paid back to shareholders in the form of dividends. Okay, any questions so far? Let me pause here and just get a sense of what are you guys thinking?
I have one question, Roshan.
Mm-hmm.
So you mentioned in the previous slide, like we can think of the share price as EPS times forward PE, right?
Mm-hmm.
And if the company can grow at a higher rate for longer than 1 year,
Mm-hmm.
how that will be coming in the into this formula? How can we think about that into this formula? Because we only look at the next 12 months, but what if the company can grow at a higher rate for longer?
So this is a very good question because essentially it relies on what lens you're wearing. If you're wearing the lens of a trader, then maybe you would look at this as an opportunity to be short the company because your time frame is maybe a couple of weeks to a couple of months, because you're seeing this as a company where a lot of long-term investors will now start getting concerned about the company not being able to generate excess EPS, right? Or EPS as per what was projected in the past. And by virtue of that, it will probably bring more downside risk to the company. But if you're wearing the lens of a long-term investor, you might be sitting there and thinking, okay, I understand why it's not able to generate that level of EPS that was estimated. I understand the reasons, and I believe these reasons will go away over the rest of my time horizon, which means that eventually the market will revalue it upwards once all of this chaos is gone, right? So this is how you need to be thinking about it. It's also what I spoke about last time, which is called time arbitrage. So the longer your time horizon, the more benefit of doubt you can give to the stock, and it will still come back to you saying to yourself, okay, I'm buying this stock at $10 today. I'm aware it's got a few headwinds for the next 2-3 quarters, but that's okay. I'm buying it at 10 because I think it will go to 100 in 5 years time. So you need to be able to see the pathway to go to 100 in 5 years time. If you're able to do that, then it's justified for you as a long-term investor to be making buying decisions. But as a trader, if you project that the next 2-3 quarters will be a bit, will be a bit difficult for the company, it will start missing estimates, then you will look at this in a totally different fashion. Because as a trader, you're like, okay, it's trading at 10. I think this goes to 8. So there's a potential for me to make to 20% there, right? So that's the difference between a trader and a long-term investor. Does that answer your question?
Yes, Roshan. Thanks.
And you see, this is also why a lot of times we can fall into this trap when we're shorting a company to call others who are buying the companies idiots. But they're not necessarily idiots, right? Everyone does a relatively good job, especially when it comes to financial markets. It's basically the divergence in opinions that make us make different decisions. And at the end of the day, everything is based off assumptions of what will happen over my time horizon versus your time horizon, right? So we can even take an example, right? Like Flow and Decor. I've been short this company from like 115. It closed at 100. Do I really care where it's going to trade in 3 years' time? No. I probably even would forget about that company in 3 years' time. I'm only looking at this specific window, maybe until December. That's the bulk of my analysis, right? I'm not really projecting forward and saying, okay, it's trading at 100 today, but look, all the difficulties it's facing, it's probably going to go away in 2 quarters' time. So maybe in 3 years' time, it trades at 500. That's not what I'm doing in this case. And it's very important to understand what game you're playing and not get the two mixed up. Right. We've spoken a little bit about this in the Discord server. Free cash flow. What is it all about? So remember in the beginning I was talking about this concept of the equity value grows in line with how much net cash flow is able to be accrued over time, right? What I mean by net cash flow, it's a loose term, and as investors, the professional term to use is free cash flow. So if you Google free cash flow, there are various definitions for it. I've got one here, which is probably the simplest. They all go in the same direction. They all lead to the same destination. But you'll see a variety of these free cash flow metrics that are out there, which can be a bit confusing. But essentially what they all allude to is what is the net cash flow that the company is able to generate. Some of these metrics would be free cash flow for the capital structure, so debt and equity at the same time. Some of these metrics would be free cash flow for only the equity portion. I've got an example, so don't be too scared about this. At the end of the day, the way we calculate free cash flow is we take the net income, so basically earnings at the end of the quarter. We add back the non-cash expenses, so these would tend to be things like depreciation as an example, because depreciation is not actually a cash expense, right? But it's still taken out in the income statement. So that's just an accounting methodology. So we add that back because at the end of the day, we want to understand from a cash flow perspective, how much net cash flow is being put into our water tank, right? We don't care about accounting metrics and so on. We're trying to just understand what is the cash flow that's actually accruing to the equity portion. And then we need to minus the increase in working capital. So this is basically, let's say if you need to order more inventory, so you need to take that away from the cash flow, because if next quarter you're going to fulfill more orders, you need to increase your working capital. You need to set aside funds for that. And then finally, as I've mentioned, we also need to set aside funds for capital expenditures. So when all of that is said and done, how much money are you left with? That's essentially what it means. Don't get bogged down by terminologies, jargon, and so on. At the end of the day, I try to sometimes maybe oversimplify things. And the reason I do this is because I want you to have a working understanding of how that is actually playing out in the business. I don't want you to be right up to the 5 decimal place. That brings no benefit to anyone. Having a working understanding of things will get you extremely far. Having a 5 decimal place mentality, it's a recipe for disaster because you're focused on totally the wrong thing, right? Getting things right to the 5th decimal place and patting yourself on the shoulder is just complete stupidity. What you need to understand is this is the real world. We don't need things to be right to the 5th decimal place. We need to be right directionally. We need to be right in terms of what's actually happening in reality. And for that to happen, you need to have a very good working understanding of these situations. I'll give you an example. A lot of my thesis, I'm trying to think, I don't remember ever creating a model on Excel. A lot of my thesis is literally written down on a piece of paper, maybe 5-6 bullet points, because it's only these 5-6 factors that would move the share. I don't really care about, downloading the financial statement in an Excel, then playing around with it, pretending that I'm doing a lot of work on the stock, because all of that doesn't matter. What matters is to put your finger on the top 3 to 5 things that are moving the stock, and then have a working understanding of what are the different factors that pull these drivers up and down, and what could essentially happen over your time horizon. it doesn't really matter if I'm right up to the second or fifth decimal place. The working understanding is very, very important. So this is a question of accuracy versus precision. Just to illustrate what I was discussing. So you have a cash flow statement here. It's basically for a company, I don't know exactly what this company does, but you can look at this in more detail at the link that's been provided below. I think that was a very good website where you can have an in-depth view on free cash flow and all the different metrics. So you would see that the company has 4 types of cash flow metrics here. One is cash flow from operations. So this is found on the cash flow statement of every company. And then they calculate the free cash flow. So this is basically the cash flow from operations, and then they take away the purchase of property and equipment, which is basically CapEx. So they take cash flow from operations minus the purchase of PP&E. So if you look here, it's 13,520 minus 1,200, and that gives you a free cash flow of 12,320. And then they've got another metric called the free cash flow to equity. This is probably more what we should be concerned as equity holders. So this essentially means what is the free cash flow after you've accounted for debt. So in that year, the company issued 3,500 of debt. So basically what you're doing is you're essentially just removing that portion from or actually adding it back into the number that you had here, right? So that's essentially what the free cash flow to equity means. So I tend to not go down into these rabbit holes until it's necessary for a particular company. What I have found is the metric that you have on Coifin is good enough to make decisions, because at the end of the day, you don't really care about calculating these cash flow numbers to the last decimal place. You care about understanding what's moving these free cash flow numbers, whether they would be higher or lower in the future, and justifying why this could be the case, right? There's a very important distinction here, because I think a lot of us, we come from the formal education system and we all want to be very good students, but that doesn't really matter in financial markets. In financial markets, understanding things conceptually, being able to predict directionally where something is going is a lot more important than getting the number itself right. So with all of that said and done, why is it that we focus so much on free cash flow? I think it's quite evident, right? At the end of the day, we want a business that's able to run, and through the money that it's able to generate, so basically the cash flow from operations, you want the business to be able to cater for all its expenses and all the investments that are required for inventory and also for capital expenditures. And after all of this, you still want to have an excess cash flow that's left for the equity holders. So high free cash flow generation power improves the equity value. There is no doubt about this. I have not seen a company that has high free cash flow generation power and the share price goes down. I haven't seen it. There must be a few out there, but it would not be because of the free cash flow generation power of the company. It would be because of something else. So the market will generally give a company that has high free cash flow generation power a lot of credit through PE multiple expansion over time. So if you go back to this slide here, the first lever for long-term equity appreciation is earnings generation power, so ability to increase earnings. The second one is ability to increase the PE multiple, and that's a very strong lever. So when you see companies going, let's say, from 1 to 10 to 100, a large part of the reason they are able to explode, into space, is because of PE multiple expansion. That's happening at the same time as EPS is growing, of course. So the high free cash flow generation power also gives management levers for other things. So if they want to increase dividends, if they want to buy back shares, if they want to pay back debt early, you can only do that if you have excess money in the bank, right? If your water tank is empty and drying, you cannot, afford all these other, let's say, luxuries, right? Like increasing dividends, share buyback programs, or paying back your debt. So companies that have healthy levels of free cash flow would generally tend to trade at a higher level than companies that don't necessarily have healthy levels of free cash flow. So for the same level of debt, as an example, two companies that are almost comparable, you would tend to see the company with high free cash flow levels trade higher, because the market knows that the debt is less of a problem if it has high free cash flow generation power. Why? Because if debt ever becomes a problem, the healthy free cash flow levels will allow the company to pay back the debt and claw itself back out of trouble. Whereas for a company where it has a lot of debt and the free cash flow generation power is not there, that company is looking down a lot of trouble and probably looking at bankruptcy. So investors understand this, and as a long-term investor, this is something you have to be focused on very meticulously. In a downturn, management can also pull these levers to protect the equity value. So a lot of times I've discussed shorting opportunities, but then it comes with the caveat that, look, the company is not kind of what I call trapped, because the management can still pull a few levers to protect the equity value. So you have to be very careful whenever you're looking at shorting such types of situations. They will still move down, but it's not going to be as quickly or as much as you think it would be, because management will do a lot to protect the equity value, and investors will keep buying the stock for that reason. So as a summary, a company with earnings generation power is good. We all like that. We want to see the EPS growing every single year. A company with high quality earnings generation power is even better. And what does high quality earnings power mean? This is essentially achieved by generating a healthy level of free cash flow. So I think I've got a couple of examples later to illustrate this. So this is the distinction I wanted to make. As a long-term investor, sure, you want to see the EPS graph going up for, let's say, the next 5 years. But what people don't focus on is also the quality of these earnings. And a good proxy for that is the ability to generate free cash flow. So many long-term investors are totally missing on this point. And this is a very big or very powerful generator of returns, as we'll see in the next slide. So I've got a chart of Apple here. There are 4 lines. So the candlesticks is basically the share price, and this goes back all the way to 2015. The blue line is revenue. So this is revenue projected for the next 12 months. And the purple line is the earnings projected for the next 12 months. And finally, the orange line is the free cash flow per share for the last 12 months, right? So you can see that the share price trades in line with the free cash flow generation power of the company, right? So there have been phases in Apple's business where it was not able to grow revenue and earnings that much. So you would see there are a few quarters where Apple has stalling revenue growth or stalling EPS growth. but the free cash flow generation power of the company keeps the share price going. And if you look back at these periods, you would tend to see that even if revenue growth and EPS growth is stalling, not going negative, but it's kind of going flat, what tends to happen is because it has a very healthy level of free cash flow generation, investors don't ditch the stock. They keep holding it because they know that when things turn around, this company will go even higher. And it also comes by virtue of the type of business that Apple gets involved in. At the earlier stage, Apple was more of a hardware company, so selling predominantly phones and laptops. And over time, it's moved away from just being a hardware seller to more of a software seller as well. So as an example, people having iCloud membership subscription fees being paid to Apple, that reduces the cyclicality of Apple's business model. And you can see that clearly in the results. You can see that clearly in terms of free cash flow generation. Between 2015 and now, we've had at least one business cycle unfold. And you can see that the metrics of this company has almost not been influenced by negative turns. Let's take an example for 2020 or early parts of 2020. During COVID, Apple did relatively fine. And if it was predominantly just a hardware seller, I think it would have struggled a lot because its stores would be closed and maybe it would not have revenue growth for quite some time until it's able to sell online and so on. But in this case, the share price just keeps going higher because the business is able to execute its strategies, and by virtue of that, fill the water tank for equity holders of Apple. That's another example, a company called Caterpillar. So Caterpillar manufactures heavy machinery, equipment like those that are used in construction, for agriculture. It's also involved in equipment that are used in mining. So by virtue of this business, it's fairly easy to understand that it's a highly cyclical business, right? So I've got the same time frame here from 2015 to 2025, and you can see that the share price has had a lot more fluctuation than Apple. And it's also no surprise that the free cash flow generation power of the company has not been the same throughout the whole cycle, right? As an example, in early parts of 2020, during COVID, you could see that the free cash flow generation ability of the company was impacted predominantly because the equipment that it sells are more tied to field operations, and if you have a lockdown, you don't expect companies to be doing a lot of these field operations, right? So this is almost like a polar opposite to Apple, and you can see that the share price also moves in line with the ability of the company to generate free cash flow. So I think this is a very good. These two are very good illustrations of everything that we've been discussing, and it probably puts things into perspective for you to really understand why is it that you have to be looking at the free cash flow generation power of a company. So maybe one last thing before we move on to the next slide. So what I'm discussing here is equally valuable for traders and investors because this is the principle by which the market works, right? And these principles are not just applicable to public market participants. If you're building a business and you want to sell it one day, these principles are equally valuable. You still want to think about these things because at the end of the day, the higher the embedded value of the company you're building, so the more the water level or the higher the water level in the water tank, the more a buyer will be willing to pay you. because that's how people value companies. And if you know these principles, these are equally valid whether you're a public market participant or whether you're doing deals in the private markets. It's also very valuable if you're working for a business, because then everything that you're doing in the strategy has to tie back to the thinking that every action needs to be able to generate the company higher free cash flow. If you're, let's say, an employee in a company and you have decision-making ability in terms of strategy, you always need to think about how would I be growing the embedded value of the business. You could do that by increasing revenue. You could do that by cutting costs. You could do that by reducing debt. You could do that by selling more products that have higher margins, changing your business model from one that's highly capital intensive to lower capital intensiveness. There are different strategies that you can deploy, but at the end of the day, your objective is the same. You're trying to increase the embedded value of your business. Let's move on to our long-term investor friends now. And even if we're talking about investing here, I think the traders should not fall asleep. It's still very, very important. So let's take a step back and understand a bit what does the investing universe constitute of. So when you look at stocks, you have what we call small caps, so companies that have market caps less than $2 billion. And then you have mid caps, so where the market cap is between $2 and $10 billion. And then we can also look at micro caps. So these are companies that have market caps below $2 billion. The reason why, as long-term investors, we have a preference for the smaller type companies is because they naturally have more room for growth, right? Compared to a larger company, smaller companies have more room for growth by virtue of having a smaller base. So we could, of course, be looking at large caps and mega caps. That nothing prevents us from doing that. But in general, if we want serious share price appreciation over our chosen time horizon, we would want to be looking at these smaller type companies. So basically, the play that we're making here is that these small and mid cap companies will eventually grow into larger cap companies. However, we also have to appreciate that there are significant risks with looking at this universe. The risks of the company failing are generally much higher as you go down the market cap spectrum. So it's very important to note that everything I'm about to say, it's pure generalization, and it's not me casting a shadow or giving a vote of confidence to any part of the market. It's just what happens or what tends to happen on average. And of course, we do so much work to be able to rise above average. We don't want average, we want to be above average. And therefore, we always want to find exceptions to these generalizations. And by virtue of what I've just said, it doesn't mean that we cannot find good opportunities in the nano micro cap space or even in the mid cap space, even if they have higher risks. Our job is to sift through it, understand what is the making of a company that goes from small cap to mid cap to large cap, and by virtue of that make us 10 times, 20 times, 50 times, 100 times our money. This is the kind of play that we're looking for as a long-term investor. But it's also important to understand or appreciate the reality, right? So in the nano and micro cap space, because they are small and they don't have as much financial strength, they have a poor capital raising power. Generally, they can only raise capital by diluting the equity. So they will be doing rights issues or what we call private placements, and these type of capital raising exercises tend to be quite dilutive for shareholders. They still lack proof of concept, so the product or service that they are producing and delivering is not necessarily past the proof of concept phase, and that in itself has a lot of business existential risk. They also tend to have poor, perverse, fraudulent management teams, so be very careful of that. A lot of management teams that have not got the shareholders' interest at heart. If anything, they're out there to abuse shareholders and direct the funds to their own private pockets. So there are many mechanisms where they do that, in which they do that. And that can literally make the company go bankrupt in a couple of years. So that's a real risk. I think that's probably the biggest risk with this universe of companies. Also, we have to note that there is very low analyst and institutional coverage for this category of stocks. And it's highly retail driven, which means you would have poor liquidity. And also, for lack of a better term, these stocks are, trading a lot on sentiment. And you would tend to see a sentiment ranging from this is an amazing company to this is the worst company I've seen on earth within a couple of weeks. So as I've mentioned before, retail investors can be fickle in nature. They tend to be overly emotional. So if you're looking for highly emotional males and you think they don't exist, go find retail traders or retail investors. You'll find a lot of them there. Jokes aside, but this is the nature of the beast, right? And it doesn't mean that's a negative thing, because by virtue of the markets being that way, it has both risks and opportunities. What are the opportunities? Maybe because it's heavily retail driven, heavily sentiment driven, shareholders might have taken the share down 90%. But when you're looking at it, you probably believe, oh, this stock could go up 5 times. And you're basically getting a very good entry into a situation that, is not a bankruptcy situation and has a potential to go up 5-10 times. So you have to first understand the nature of the beast and then, figure out how to play the game to make sure that you stack the odds in your favor. When we move to the mid-cap space, this is predominantly based of companies that have achieved proof of concept. So they would be financially stronger and they would have gone past this phase of raising capital every 2-3 quarters to now being able to generate capital from sales of goods and services. So they would have some funds, they would have cash balances, they would have the ability to generate free cash flow, which reduces the dilution risk. It's still not zero. You still have a couple of mid-cap companies that still would do rights issue and dilute shareholders, predominantly in a downturn. So it doesn't mean that if you're looking at mid-cap only that you're taking that risk away 100%. Also, generally what you would tend to see is that these companies have a product that works, they have a distribution channel that works, and they have kind of established the protocol for getting the product to market. Now what they're doing is they're basically just scaling that business. So they might be looking into new markets, they might be opening new stores, they might be doing new partnerships to be able to grow the scale of their business. You don't necessarily have to ask yourself whether this product actually sells. They have already proved that. And now basically what they are about to prove is that they can scale this business model and get it from maybe, let's say, only being in a particular state to being across the US and achieve that plan or that expansion plan within the next 5 years. So these types of situations are very strong drivers of share price appreciation. Generally, you tend to find better management teams because they get paid a lot better than nano and microcap companies. So these are people that are at the top of their game. They don't necessarily indulge in fraudulent activities like you would see in nano and microcap spaces. And these management teams also tend to be either highly entrepreneurial, or they probably have worked for established large or mega cap companies in the past, and now they've moved out of these companies to establish, their own companies or work for smaller companies where they can execute on their views much better and in a more scalable fashion. This mid-cap space also has higher analyst and institutional coverage. What that means is there's more liquidity. So if you want to have larger positions, that's not really a big concern. Whereas in the microcap space, sometimes wanting to have a larger position means you own 1 or 2% of the company, which is a bit of a problem. And if you go above, I think 9%, you need to start disclosing that to the stock exchange, which is a massive issue. So, and also, if you want to exit the position, imagine you own 2% of the company and you're selling that in the market for a couple of weeks, you're just going to kill the share price. So if you have more capital to deploy, you probably want to be looking at the mid-cap space. Okay, so let's now move on to the last part of the presentation, fundamental stock analysis. So basically, what is it that we're trying to do, right? As I've mentioned, we have a market where there are a variety of market participants. Now we have to define what type of market participant do we want to be. Do we want to be the short-term market participant, so a trader that looks at a horizon of 4 to 10 weeks? Do we want to be more of a medium type of market participant? So this could be a trader / investor. Basically, you're looking at 10 weeks to maybe a year. Or do you want to strictly be just a long-term investor? So let's say you have a time horizon of 1 to 3 to 5 years. So you have to define this, because if you start getting this mixed up, it will be difficult for you to understand exactly what you're doing and when is it that you're right, when is it that you're wrong. You can still have two portfolios where one you're a trader and the other one where you're a long-term investor. I think that's a good practice, because you need to know what hat you're wearing whenever you're doing actions within each types of portfolios. Because what I've seen is a lot of people get it mixed up. So a bad trade turns into an investment, and then people just think that by virtue of me giving it more time, it will work, and it doesn't. And then you're stuck with a position in your portfolio for the next 2-3 years, and you just cannot sell it because it's gone down so much. And that's a very bad situation to be in, because you've exhibited all the wrong behaviors. You haven't stuck to your plan. You've been a victim of thesis creep, and you've literally gone from objectivity to fully subjective and fully emotional. And these are not behaviors that will tend to be rewarded in the stock market. Whenever you're analyzing stocks, you need to focus on the factors that would create equity value for you over your chosen time horizon. So this is a little bit maybe less relevant for short-term traders, but it's very relevant for long-term investors, as we've discussed in the past, right? And as you move along a longer time horizon, you have to realize that there are many more variables that come into play. Most importantly, there are many more unknown variables. So this is something that people don't realize. You go into a thesis thinking that, this company has 5 different things that can impact it. After a year, the company looks totally different. and your thesis is almost unrecognizable. And that tends to happen more often than not because there are so many unknown variables out there. Like, who could tell that the interest rates would go all the way up to 5% in such a short period of time? Probably no one. Who could have predicted that, the stock market would go up 4 or 5% in a week because Trump got elected? It's very difficult to understand what the future has, especially in a world where there's a lot of things changing at a policy level, at a global level. And as a long-term investor, I think it's getting a lot more difficult to be able to think about a business 5 years from now and understand what landscape it will find itself in. So at various points in time, the market will be focusing on different factors, giving more weight to macro versus micro, and the share price will also move accordingly. So as an example, I'm sure it's happened to you a few times where you look at a company and you're like, yeah, this company is beating earnings, beating revenue. It's launched this new product and everything, but the market doesn't care. The share price is still down. It's not moving up, or maybe it's like up 5%. And it's not getting the kind of recognition that you would think based on purely company specific metrics. And the reason there is simple. The market is just not focused on the company specific factors. In that time horizon, the market is more focused on the macro. I'll put that into perspective. When the Fed increased interest rates rapidly from November 2021 onwards, a lot of tech stocks were still outperforming. They were printing great numbers, in terms of financials, the KPIs and everything. But the market would just not care. And these stocks were going down 50, 90% over 6 months. And that's despite them still running the business, growing the business, and producing results for the shareholders. But the market did not care because the market was solely focused on higher interest rates. And these are the factors that you have to take into consideration if you're a long-term investor. You will not necessarily know what inflation would look like in 5 years' time. And on that basis, what interest rates might look like, what liquidity conditions would look like, and so on. So these are all the factors that when you're taking a view over, let's say, 3 to 5 years, these are all the unknowns that you'll have to be able to build into your thesis in one way or the other, and also have good sleep at night that somehow it's gonna work, because you genuinely do not know where these rates will be in 2 to 3 to 5 years. And these rates are extremely important in determining the share price of your company. So why is it that we pick a shorter time horizon as traders? It's predominantly to reduce the unknown variables and for us to solely focus on what we believe is currently driving the stock and financial markets in general. I believe this gives us a higher probability of winning, and of course that means that only makes sense if we are focused on the right things. It also gives us the right level of volatility to be able to capture outsized returns when we're right. So without volatility, if the price doesn't move, there's no way we can make returns. The price has to move significantly so we're able to make returns, right? And something that doesn't get discussed at all, as a trader, the feedback loop is very fast. And the faster the feedback loop, the quicker is your learning cycle. So imagine being a long-term investor where you're not necessarily getting feedback from the market for almost a year, 2, 3, 4, 5. And in that time, you might have even changed jobs, which means you have no way to verify that the decisions you made in the past are still good or, still working. So the feedback loop is so slow because you have multi-year hypothesis, and you will only know whether you were right or wrong after many years. So contrast this with a trader's life, where every 4 weeks, every 4 to 10 weeks, the trader is getting live feedback from the market. So you can imagine how much more refined a trader's understanding of financial markets will be compared to long-term investors. And it's no surprise, when I speak to, let's say, institutional fund managers, like the long-term focused ones, let's say long-only funds, like pension funds and so on. When I speak to these portfolio managers, it's almost like you want to cut short the conversation, because you're talking to someone that has a level of understanding that's so rudimentary, and they're focused on totally the wrong things. And it's almost like you're like a university student speaking to a primary school student. And it's not me being derogatory or anything like this. It's by virtue of this feedback loop, right? The long-term investors haven't had as many opportunity to learn and to get real feedback from the market, whether that's good or bad. So I tend to think that if you're a retail market participant, a large part of your learning comes from interacting with the market. And if your feedback loop is fast-tracked, you will tend to learn a lot quicker than your peers that are in the institutional world. So that's something to keep in mind. It's extremely important, and it doesn't get spoken a lot. I have never seen anyone speak about it. You have guys like Warren Buffett and all of these other prominent investors, but you never hear them speak about this thing, right? Even traders never speak about this. And finally, I've got 2 more slides to go. So when it comes to fundamental stock analysis, we can break it down in 2. One is the quantitative analysis. So quantitative just means everything that's measurable, numbers. It's just numbers, numbers, numbers. So these would tend to take the form of financials, so revenue, expenses, margins, cash flow metrics, earnings, etc. You also have building blocks of financials, KPIs. These give you an extra level of understanding of what's moving these financial figures. As an example, KPIs will allow you to understand where is revenue growth coming from. Is it from having more users, from increasing prices, setting up new stores, or is revenue growth predominantly coming from new stores versus existing stores? It will allow you to paint a better picture on that basis. As opposed to just looking at revenue growth as one number, it will allow you to understand what's driving that, where is it coming from. Another example is if you see margin improvement in a company, KPIs will allow you to understand if that's coming on the base of higher efficiency, higher prices, and also it will give you a sense of whether this is sustainable for the future, which is a very important question to ask yourself as a long-term investor. When we talk of quantitative analysis, we also have to focus on industry analysis. So for any company, you would have a couple of companies that are comparable, and as part of that, they will also have comparable metrics like growth rates, margins, like-for-like KPIs, although this is a bit more difficult sometimes. But companies in certain industries would have KPIs that can be compared versus their peers. Or sometimes you can still compare them knowing that, one has a slightly different model than the other and making an allowance for that. You also have qualitative analysis. So as a long-term investor, this is extremely important. quantitative analysis is equally important, but qualitative analysis is what makes the biggest difference for a long-term investor. As a long-term investor, you need to understand what are the competitive factors of the company. And most importantly, what are the long-term competitive factors? How sustainable are these competitive factors? You will need to understand what is the product pipeline looking like. Are they introducing higher margin products? When will they be launching? What would be the impact of these new products or product mixes on the company's metrics? You'll need to be able to assess the company's strategy. So the main question you would have is, based on its strategy and if they execute well, what is the upside surprise for the provided guidance? So if the company says it will have EPS of 10 in 5 years' time, what is the upside surprise to that? What is the potential for them to do 12, 15? Because that's essentially what's going to drive the share price much higher for you. A lot of your discussions and questions would be around what is the total addressable market of this product? How expandable is this? What is the go-to-market strategy of the company? Is this strategy going to allow them to address a large part of this market that they've identified? Can the company capture this? If the company has an expansion strategy, let's say through acquisitions, is this the right type of industry to be making acquisitions? As an example, let's say you're in an industry that's highly fragmented. This type of industry tends to be ripe for acquisitions, so where you have consolidation of an industry. But if you're in a different type of industry where you will have to be paying significant margins to acquire your peers just to grow market share, that probably is not the best of strategies, and the company will need to take debt to be able to make these acquisitions and then spend a couple of years just integrating both businesses only to realize it doesn't work. We've seen so many examples like these, right? And as a long-term investor, you're basically just, if you're invested in the company, you're basically just swaying around with all these narratives, these shenanigans from management that, this is working, this is not working, and you'll feel like you have no control on the situation. You've just basically outsourced all of this to management, and it's a big execution risk. With regards to expansion strategy, you sometimes also have to ask yourself, does the company has the level of capital to be able to achieve that strategy? If not, it probably means it has to fund this expansion strategy through debt. Is this a sensible strategy? Will this put the company in financial distress if it's taking elevated levels of debt? What is the cost of debt at which the company will be able to raise money? All these questions come into play, and say it's not. These are highly subjective factors when you're looking ahead to the future. And as a long-term investor, you'd be able to, you should be able to have an answer for these types of questions, or at least have thought about it, because a lot of times long-term investors will speak to management, especially with smaller companies. And these are the types of questions you have to be asking management, because they'll give you a much more refined view of what the future looks like. Another thing to be very close to is understanding the unit economics. How are the unit economics working for the company, and how are they going to work in the future? Let's take an example where, let's say you have a dental practice and they are expanding into a new state or a couple of new states. So the unit economics achieved so far, unit economics basically means if you have one store, what are the metrics that store is able to generate? Is it profitable? How much capital do you need to invest to set up the store? And what is the payback period? When does that store starts becoming profitable, and when does it start generating free cash flow for the business? And if you were to replicate this across the US in other states, would you have similar types of unit economics? These are questions you'd have to ask yourself, because a large part of your thinking is along the lines of what will the future look like? Is the view that management is painting, is that sensible? Is that realistic? Is there upside surprise to that plan? So this is a lot of the work that you'd have to do from a qualitative analytical perspective. You'll also have to understand management's view on the industry and the company. If you don't have direct contact to management, a lot of this can be sifted through these investor conferences, transcripts, or even earnings transcripts every quarter. Management will give you their views on the industry and the company at that point in time. Some analysts do ask very good questions, so it's important to go through these question and answers section and just get an update on their view, and from that perspective update your model and thesis as well. As a long-term investor, you also have to do a bit of work in terms of assessing management's track record of execution and keeping promises. So this is very important, because as a long-term investor, you're literally married to the management team, right? Your fate is tied up to what these guys decide to do. And you have to make sure that these guys have the shareholders' interest at heart. This is a big risk for any company. As a short-term trader, you don't focus this much on management quality, because you're not involved on a long-term basis, right? As a long-term investor, this is the bulk of what you'd be doing. Is this management team credible? Have they done it in the past? Is there any divergence between what they've said and what was done? Are there red flags that I need to be aware of, right? How does this management behave when there is a downturn? Do they deleverage? Do they reduce debt and when the company is going into a downturn? Or do they just act recklessly? Do they take decisions that put the company more into financial distress? Because over your time horizon, the company will go through ups and downs, and you're literally wedded to this management team, and your fate is tied to the decisions that they'll make. And then, irrespective of whether you pick a small cap, nano cap, mid cap, or large cap, you still have to ask yourself, what is the dilution risk of the equity? Can the company raise capital cheaply and easily? If not, there's a much higher risk of equity dilution going forward. You also have to ask yourself, how much leverage does the company have? Is this something you're comfortable with? Is this increasing or decreasing in the future? And by virtue of that, what would that mean for the share price of the company? So a large part of the qualitative analytical process involves painting a story for the company and of its industry. And then literally what you'll be doing is, the story that you're painting will essentially be justified by the numbers that you've gotten through your quantitative analytical process. So you'll be painting a story about the past of the company, where it's come from, where it's at, and eventually a large part of your focus is, what could this company turn out to be in the future? That's the story that you would be painting. And when I speak of story, it's essentially your thesis as a long-term investor. So let's say you have a stock for 5 years, you plan to have it for 5 years. Generally, you'd be reassessing your thesis every quarter in line with the results. And then as a long-term investor, it's very important to make sure that you always look at the results in line with what your expectations were from your thesis. And whenever things are not playing out, it's very important for you to ask yourself if my thesis has been disproved or not. And it's much easier to say than to do, but you need to be very objective when answering this question. It has to be yes or no. It cannot be yes, but then, you answer it in a way that is nuanced and gives you no sense of direction as to what you should do with the position. There are many cases where, because we've been invested in the company, we've looked at it for so long, it prevents us from taking the most logical actions, because I call it the sunk costs fallacy, right? You've invested so much time, energy, effort looking at a company, and over your time horizon, it's just not executing as you expected. But then you're like, no, let me give it more time. This will work out. This will work out. This is more like hope, as opposed to being objective about what's going to happen. And it's very important for you as a long-term investor to realize that you're not going to get this feedback loop from the market every now and then. So it's important for you to be as objective as possible and to almost act impartially, because when a thesis is not working, giving it more time is not always the solution. It's more likely to go south than to go along, what you had projected the thesis would look like. So again, both as a trader and as a long-term investor, emotional discipline is extremely important. You need to stick to your plan. You need to revise your thesis and ask yourself, these are the set of assumptions. This is the set of assumptions that I set out with. How far are we from these? And is the company still going to be able to, play by my thesis, or has my thesis been completely shattered? In which case, you should just sell the position and move on. I think that brings it to the end of my presentation. I'll open up for any questions that you might have. Yeah, I can hear you.
Great. Just so a query here, Roshan. You commented on the issue where if you want to invest long term, there's obviously many more unknowns.
Mm-hmm.
I guess basic question is, how do you deal with that element of it? Because we know, obviously, I know you've highlighted that as a salient difference between
Mm-hmm.
long term and short term. But then, does that mean you regularly review your thesis every week and compare that against company actions, or how does that crystallize in terms of action points
So,
for a long term strategy?
so the first thing is recognition of this, right? Awareness that there are many, many more unknowns. I have not heard many long-term investors that are very vocal about this, which begs the question as to whether they even understand that this is the clear distinction between short-term trading and long-term investing. The first step is always awareness and acknowledgement that this is going to be the case. And now that you understand that this is how it works, this is the nature of the beast, of course, there's a lot that you can do to mitigate this and almost stay ahead of that. A weekly refresh might be too frequent. You won't have data to do a weekly refresh. A quarterly refresh is a bit more sensible. And also in between quarters, you might have industry reports that are coming out. So you would want to take a look at these and just quickly understand, what does this mean for the industry and for the company? Is this a short-term thing that will go away in a couple of quarters? Or is this like something that is changing the industry on a more long-term basis? So this is basically what I would call, is this a cyclical change, meaning the change is by virtue of the business cycle going up or down? Or is this a secular change, which is a more long-term, like a paradigm shift, right? So it's important to recognize that you've picked a different time horizon, and everything that you assess in the short term has to be put into perspective from a long-term investor timeline, right? So, of course, staying aware of the information flow is one way to do it. What I have found personally, because I'm both a short-term trader and a long-term investor. Being able to wear the hat of a short-term trader has allowed me to take a bit more of a different approach to my long-term investments. So whenever there's a situation happening in the market, I'm able to assess it from a short-term trader's perspective, which, as you would have seen, is a lot more actionable, a lot more, okay, what's happening now, what's going to happen in the next quarter or two. So it's a lot more realistic as opposed to a long-term investor's thesis that tends to have a lot of assumptions. I think what has served me well is, even if I'm a long-term investor, when there are significant things or events happening for one of my long-term investments, I will wear the short-term investor hat or short-term trader hat to try to understand how far out from my thesis is that event. Is that event disproving my thesis? Because you'd agree with me, right? If you're in a wrong situation, the best thing that you can do is to get away from it as soon as possible. And for you to be able to do that, you need to have the right analysis and elements that give you conviction that you're in the wrong situation, right? It's not different from, let's say, relationships. You're going out with someone, of course, both of you want to make it work, but along the way, you notice things that sometimes you give a bit more benefit of doubt, knowing very well within you that, this is a bit of a deal breaker, right? So it's not very different, because at the end of the day, it comes down to human nature. Whenever you're projecting into the future and trying to forecast, a large part of your personality comes through a large part of your makeup, how you think about situations, how objective or subjective you are about situations. A lot of these cognitive biases come through, and that's essentially impacting the decisions that you're making. So it's very important to recognize this and, just try to not get in your own way and make good decisions. I think one thing that also helps a lot is to study companies that have been proven winners in the past. I always say success leaves footprints, right? So study these companies and don't just look at the company's specific factors that made them a success. Drill down a bit further and try to extract the principles that make them successful. As an example, when we say free cash flow generation power, earnings generation power, dividends policy, this is irrespective of industry, irrespective of company type, market caps, and so on. It's almost like a principle, right? So if you understand things from a fundamental perspective, and then you apply it onto situations, you tend to see things a lot more objectively. And when they're not working out, you'd ask yourself, okay, is the company going to increase EPS? I cannot see that happening. Is the company's PE multiple going to expand? I cannot see that happening.
I have another question.
Yep.
So you mentioned about a fraudulent management is a big risk for small caps,
Mm-hmm.
right? And can you tell a little bit more about the mitigation strategies to identify and make a decision whether do you want to be?
It's a difficult one because everyone looks at first sight, everyone looks professional. Everyone looks like they know what they're doing. There are red flags, overly promotional management, management who are delusional. So something happens and the answer they're giving you is just like not making any sense, right? Also in terms of their actions, so you could look at related party payments. So that's normally disclosed in in the financial filings. So there are situations like the building that they are in is being rented from the CEO. Things like these don't sit well with me. It could be legit, but these are the kind of red flags that you have to note them and then ask them about it. Sometimes you can also look at previous dilution events that have happened. How do they do it? For what reason? What do they use the funds for? Generally, if they raise fund to expand the business, you would want to see expansion, right? If you haven't seen the expansion, where has that money gone? That's the question, right? There are many like different fraudulent, but not necessarily illegal. I mean, let's call it this way: there are many immoral practices that are not necessarily legally fraudulent, right? So they would still say, no, look, I've done everything as per the rules, so I'm not being fraudulent. But from a shareholder perspective, you're getting fleeced, and you're actually holding the bag for all these actions that they are taking. There are many examples, like audits being missed, auditors delaying. Why would an auditor delay their reports? To a large extent, it's because there's not agreement between management and the auditors on the findings. So they are trying to quell a lot of things that the auditors have uncovered. It's not always the case, but these things have to be questioned, because as a shareholder, you have line of visibility until the financial filings, right? You cannot see further than this. And if these filings are being challenged in terms of their veracity or accuracy, it's a big problem. Do you even need to be involved in that situation? It's all. You've also got situations like they miss the filings for like different stock exchanges will have regulatory deadlines, and they miss that for whatever reason. So all of these are examples of what terrible management teams do. And what you could also do is take their names, Google them, read everything you have to find on the internet about them. And if they've done shady things in the past, I'm sure there would be someone who writes about it and has to tell you a good story about their shady practices. So yeah, I mean, these are the things. There's a whole long list. Maybe that's another webinar. I mean, I can give you a lot of examples with names and companies, but then I'd get sued by these guys, so I cannot go there.
Just not go there, but I understand.
I'll give you an example. Like I had an investment in a company that produces health care related software. So for many quarters, the CEO comes out and says that they're doing well. They will publish the number of members that they are onboarding on the platform. Then they start doing that, but then you realize they're not collecting money. So there's a bit of issues in terms of, okay, we're getting people on the platform, but they're not necessarily collecting money from them. And then supposedly they've initiated a plan for collecting that money. You keep giving them benefit of doubt. Then one day, the CEO resigns because of illness, right? And then the company is halted from the stock exchange because they haven't filed their reports according to the deadline. Then now you're stuck, right? The auditors are not, the audit report is not being published. So the stock is halted. You have no financials for almost 6 to 9 months or something. You're sitting in a bad position, right? Could you have foreseen this 2-3 years ago when you got involved? This is difficult, right? But then, should I have acted? Maybe I should have acted at the first sign of them deviating from the path. But these are situations that are happening right now, where I've got a sizable holding, and I have no clue whether that situation is worth zero or not. So it's not a great position to be in. And whenever I've lost money, I'll put it this way: I've lost more money doing long-term investing, which is supposedly in the head of many safer. I've lost a lot more money there than I've lost as a short-term trader. Because as a short-term trader, I know exactly what my losses are, right? I know exactly what my timelines are, and this is it. But when it comes to long-term investing, you have a little bit more leeway, right? And generally, my biggest losses have come as a long-term investor versus a short-term trader, and that has a lot to say. Yeah. Any other questions? And all of my losses, just to put it on the record, just in case these management teams are listening, all of these losses are 100% down to management teams. 100% of them. Any other questions?
Thank you, Roshan, for being open about your losses too.
Yeah, I mean, it's all part of the game, right? It's not just wins, I can promise you that. Even in trading, like, your win rate will typically be around 50%. If you're a good trader, maybe 60. So half of the time you feel stupid for the trades you've got in your portfolio, but this is how it needs to be.
Great. I might have one question, but it was a little bit early in the
No,
slide.
go ahead.
Yeah, you mentioned about the risk sentiment being one of the things that move the share price in the short term, right?
Mm-hmm,
And with the Discord server chats, the
mm-hmm.
risk sentiments tend to swing really fairly frequently. Maybe in days it goes from like on
Correct.
to off, right, from the
Mm-hmm.
comments. So how do you how do you put that as a catalyst in your idea or thesis at one point when you're looking at one company?
So are you talking as a long-term investor or from a short-term trader
Short-term
perspective?
trader point of view?
Okay, so if you're a short-term trader, then the risk sentiment is more important to you as opposed to a long-term investor. It's still important as a long-term investor because you want to understand why the share is trading at this price. So if risk sentiment is prevailing at that point in time, you need to understand that the share price is depressed because of maybe high PE stocks are not in favor with the market. That's why I'm getting it at a discount. Let's put it that way. As a short-term trader, your returns are heavily driven sometimes by risk sentiment or positioning, right? And then by the company specific metrics. It's an interplay between the two. So risk sentiment, it will encompass liquidity conditions, macro environment, positioning of the market, rotation of capital from, let's say, cyclicals to defensive and vice versa. And then you also have the other side of the coin, which is shifting future expectations for your company, which let's call that the micro. So as a short-term trader, it's an interplay between macro and micro. What's being given more importance by the market at that point in time? So how do you deal with that? There is a very good reason why I've done this price action analysis a few times now, because this is literally what you need to be thinking of as a short-term trader. Where are the winds blowing? How long do I think these winds will blow in that direction? This is the question you're asking yourself. You would see sometimes, like most of the times, I'll say, don't fight the market, don't argue with it, don't be counter Don't trade against the trend, right? But in some cases, you also have to be contrarian because you think that maybe there is a risk of capital rotation. So as a short-term trader, you're asking yourself these questions. Where is the wind blowing? What is the market like at the moment? The market is risk on. It's liking consumer discretionary, it's liking energy, it's liking banking. How long is that likely to keep going? If you ask me, consumer discretionary, it's highly linked to consumer sentiment, which is improving every month. So is there room for that to keep going? Yes. So by virtue of that, let's say you put one position in your portfolio which relates to consumer discretionary. Now you also have to understand that if you've taken that view, you're basically saying that you think this risk-on behavior will continue and that consumer sentiment will keep improving, which will make the whole consumer discretionary sector go even higher. However, when it comes to portfolio diversification, now you have to understand that you need another idea that's not correlated to that theme, right? You cannot buy, let's say, you cannot say, okay, I'm gonna buy, let's say, CarMax. And then you say, I also want to buy another company that manufactures boats. I also want to buy another company that manufactures recreational vehicles. And then I want to buy, let's say, a clothing store. These are all just one trade, right? So you put one trade recognizing the direction of the winds, but then the next few trades that you put into your portfolio have to be around different themes, or even one theme where you're saying to yourself, what happens if we get a change of heart and we move to defensive? I need to have a way to participate there, right? So this is how you're thinking as a short-term trader, because you've done well by recognizing that these trends can move daily, weekly, a couple of days, and the flux there is very heavy, right? And by you recognizing this, you should also position your portfolio accordingly. I don't know what's going to happen in December, but I want to have positions in my portfolio that would benefit in that particular scenario that could unfold in December, right? Because I recognize that I cannot tell you in the next 3 weeks whether it will be risk on or risk off. I have zero idea. But how do I mitigate this? I pick situations that would work if it's risk on. I pick situations that would work if we move to a risk off sentiment. And then by virtue of making that choice, I know that it's going to be either one or the other that will work, right? So that's all coming as part of diversification in your portfolio. And it's very, very important as a short-term trader, because you can get things right on a fundamental company perspective and the share price doesn't agree with you. I mean, we have a situation, right? Like we are right on CarMax. We have not missed anything on CarMax. And yet the trade doesn't look like it would work. It was working until Trump got elected, right? So even as a short-term trader, we've got like one unknown that impacted the share price. Now imagine if you're a long-term investor, how many such unknowns would you encounter on your path? It's not like we did not know that there's an election. We did not know there was a possibility of Trump being elected. We knew that fairly well. But we never anticipated that this would impact the short thesis on CarMax, and yet it did, right? So how do you manage this? It's almost like the market giving you a middle finger, right? But you still have to trade it. You've got a portfolio to manage. So You need to have another position that, if Trump gets elected, would make a lot of money. In my case, it was Floor and Decor. The stock literally created after the announcement of elections. So the shorts that haven't worked have kind of been offsetted by FND. You could have put other ideas that would have worked equally well too.
Makes sense.
And that's why, your hit rate will be 50% or around that mark, because you're being highly diversified.
Yeah. Thank you, Roshan.
If we haven't got any questions, I'll probably end here. Hope this was useful, and see you in the Discord server.
Okay. Thank you, Roshan. Happy birthday again.
Thanks a lot. Cheers. Bye-bye.